Okay, so you want to run the world, not just conquer a few territories, not just win a war or two. You want to control 1/4 of the Earth's landmass, redirect 1/3 of global trade through your own ports, and turn every piece of land you touch into a machine that pays for itself. Sounds ambitious, sounds expensive, sounds frankly impossible. And yet, for roughly 200 years, a single island nation sitting in the cold gray waters of the North Atlantic did exactly that. Not through sheer military domination alone, and not through some unique streak of genius. Through economics. Through a system so precisely engineered to extract value from the edges of the world and concentrate it at the center that historians are still arguing about its implications today. At its peak in the early 20th century, the British Empire governed over 400 million people across 6 continents. It administered territories from Bengal to Barbados, from Lagos to Lagos in the Canadian interior. It owned or controlled railways across 3 continents, telegraphs across 3 oceans, and a navy that could park itself outside the harbor of any nation on Earth and politely suggest that a trade deal would be in everyone's best interest. It was, in purely operational terms, the most expansive commercial enterprise in human history. This is not a story about colonialism the way your history textbook told it. This is the ledger behind the legend, the receipts behind the empire. And by the time we're done, you're going to understand not just how Britain got rich, but how it rewired the entire global economy so thoroughly that we are still living inside the machine it built. Before we talk about how the empire made money, we need to understand why it was Britain that built it in the first place. Because this was not an accident. Start with geography. Britain is an island, which sounds like a disadvantage until you realize what it actually means. No land borders. No perpetual threat of invasion from neighboring rivals. While France, Prussia, Austria, and Spain were burning their treasury on standing armies of hundreds of thousands of men, armies they needed simply to survive, Britain could keep its land forces comparatively lean and pour its military spending into one thing: ships. The Royal Navy was not just a fighting force. It was a mobile investment in global market access. Then there was the financial architecture. The Glorious Revolution of 1688 restructured the English state around secure property rights and accountable governance. 6 years later, the Bank of England opened its doors, giving the Crown and private investors access to deep, reliable credit markets at interest rates that continental rivals simply could not match. When Britain needed to fund a war or expand a trading network, it borrowed cheaply and quickly. When a French king needed to do the same thing, he paid more, waited longer, and often had to promise things he could not deliver. Low aim on top of that, an agricultural revolution that freed up labor decades before the industrial one, and a domestic coal supply sitting conveniently beneath the exact region where the first factories were being built. And you start to see the picture. Was this luck? Partly. Was it design? Also partly. But here is what matters for our purposes. By the mid-1700s, Britain had a unique combination of cheap capital, military reach, and industrial capacity that no other nation on Earth could match. And it was about to use all 3 simultaneously. Here is the fundamental structure of how the empire actually made money. Strip away the flags, the portraits of generals, the speeches about civilization, and what you have left is a business model that economists today call the colonial loop economy. The loop worked like this. Colonies, India, the Caribbean, parts of Africa, were organized to produce raw materials: cotton, jute, indigo, timber, minerals. These materials were extracted and shipped to Britain. Inside Britain, factories converted those raw materials into finished manufactured goods: textiles, metal tools, machinery. And then those finished goods were shipped back to the colonies and sold. At a profit. Here is the catch. The colonies were legally and structurally prevented from doing their own manufacturing. Local industries were suppressed, outcompeted, or actively legislated out of existence, which meant that the colony had no choice but to buy the finished product from the very country that had just taken the raw material at the price Britain decided to pay. It is a closed circuit. Britain owned the inputs, the manufacturing, the transport, and the market. The colony owned nothing except the land it could no longer fully use. Every turn of the loop generated profit that flowed in one direction, toward London. This was not an accident. This was policy. Before the industrial colonial loop could run at full scale, Britain needed startup capital. And that capital came from one of the most brutal commercial systems ever constructed: the Atlantic triangular trade. The circuit worked in 3 legs. Ships departed British ports: Liverpool, Bristol, London, loaded with manufactured goods, textiles, firearms, metal tools, alcohol. These were carried to the West African coast and exchanged for enslaved human beings. The enslaved were transported across the Atlantic under conditions so horrific that estimates suggest between 10 and 20% died during the crossing alone. Those who survived were sold into plantation labor in the Caribbean and the American colonies, where they produced sugar, tobacco, raw cotton, and indigo. Those crops were shipped back to Britain, where they fed domestic factories and domestic consumers. At every leg of this triangle, someone made money. The slave trader, the plantation owner, the merchant house, the insurance underwriter, the London bank that financed the voyage. The profits cascaded through the British economy and settled into financial institutions that would later fund the Industrial Revolution. Economist Eric Williams argued in his 1944 work, Capitalism and Slavery, that this capital accumulation was not marginal to British industrialization, it was foundational to it. The historical debate about the precise proportion continues, but what is beyond dispute is that Lloyd's of London underwrote the ships. British banks held the mortgages on the plantations, and the cheap sugar produced by enslaved labor provided calories that fed the urban working class at a cost that made British industrial wages viable. When Parliament passed the Slavery Abolition Act in 1833, the British government allocated £20 million, approximately 40% of its annual budget at the time, not to the people who had been enslaved, but to the 46,000 individuals who had owned them, as compensation for the loss of their human property. The emancipated received nothing except a mandatory apprenticeship period of unpaid labor. To fund the compensation payment, the government issued long-dated government bonds that were absorbed into the national debt and were not fully redeemed until 2015. British taxpayers were still paying off the debt incurred to compensate slaveholders within living memory. The triangle trade was not a side chapter in British economic history. It was the seed capital, and the settlement that ended it tells you everything about where the economic and political power actually sat. If the triangular trade was the startup funding, India was the operating revenue. And the numbers are staggering. Before British conquest, the Indian subcontinent generated roughly 1/4 of global GDP. It was the world's leading exporter of finished cotton textiles, with artisan weavers in Bengal and Gujarat producing cloth that commanded premium prices in European markets. This was not a backward economy waiting to be civilized. It was an industrial competitor. The British entry into India came through the East India Company, which won military control of Bengal at the Battle of Plassey in 1757 and consolidated it at Buxar in 1764. With those victories came the Diwani, the right to collect land revenue across Bengal. And here is where the economics became genuinely extraordinary. Before the conquest, if Britain wanted Indian textiles, it had to send gold to pay for them. After the conquest, it collected land taxes from Indian farmers, used that tax money to purchase Indian goods, exported those goods to Britain, and sold them at a profit, or re-exported them to Europe for gold and foreign exchange. The Indian consumer was paying, through taxation, for their own goods to be shipped away. There was a specific financial instrument designed to make this circular extraction invisible. Foreign merchants wanting to buy Indian goods were required to purchase council bills, a paper currency issued only in London, using gold or silver bullion. The hard currency stayed in London. The Indian producers received rupees drawn from local tax revenues. What looked on paper like international trade was, in practice, a closed loop in which Indian taxes paid for Indian exports that generated British foreign exchange reserves. Economist Utsa Patnaik, drawing on 2 centuries of trade and fiscal records, calculated the total drain from India to Britain between 1765 and 1938 at approximately $45 trillion in today's terms. That figure is contested, but the mechanism it describes is not. India was funding Britain's rise using India's own money. The vehicle for all of this was the East India Company, and it remains one of the strangest institutional experiments in economic history. Chartered on the last day of 1600, the EIC was a private, joint stock corporation with a government-granted monopoly over British trade east of the Cape of Good Hope. It raised capital from shareholders, operated under a board of directors, and returned dividends. Standard corporate mechanics. Except that by the mid-18th century, the East India Company also commanded a private army of approximately 260,000 soldiers, roughly twice the size of the official British military at the time. It collected land taxes. It tried and sentenced criminals. It conducted diplomacy. It declared wars. At its height, it governed over 100 million people. This is the first multinational corporation in the modern sense, and it ran a sovereign state as a profit center. The EIC pioneered practices that would become standard for modern global business. Supply chain management across multiple continents, institutional lobbying in the home government, and the use of legal frameworks to insulate shareholders from the consequences of what their entity was doing on the ground. When the Indian Rebellion of 1857 made the company's governance untenable, the British Crown stepped in, not to end the extraction, but to take it over directly. The Government of India Act 1858 dissolved the EIC and transferred authority to the British Raj. The mechanism continued. The branding changed. Here is where the economics becomes a self-reinforcing machine. The colonies gave Britain cheap raw materials, particularly raw cotton from India and the American South. British factories, powered by coal and organized around mechanized spinning and weaving, converted those raw materials into finished textiles at a scale no artisan network could match. The costs were lower, the output was higher, the profit margins were significant, but here was the problem every industrial operation faces. You can build factories that produce more than your domestic market can absorb. You run out of buyers. In a closed domestic economy, this becomes a growth ceiling. The empire solved that problem by providing captive markets. Colonial populations in India, in Africa, in the Caribbean, were legally required or economically coerced into purchasing British manufactured goods, even when local alternatives existed. India alone, with a population of several hundred million people by the late 19th century, represented a guaranteed export market of a scale that no free market equivalent could have provided. This loop, cheap inputs in, protected markets out, was not a market. It was a subsidy paid by colonial populations to British industrial capital, and it operated for over a century. The railways built across India in the 19th century are often cited as evidence that empire left something of value behind. And the railways were real. By 1900, India had one of the largest rail networks in the world. But understand what those railways were built to do. They ran from the interior, from the cotton fields of the Deccan, from the jute farms of Bengal, directly to coastal ports. Bombay, Calcutta, Madras. They were built to move raw materials from where they grew to where ships could carry them to Britain. They were not built to connect Indian cities to each other. They were not built to facilitate internal Indian trade or industrial development. The financing structure made the extraction even more explicit. Under the guaranteed return system introduced in the 1850s, private British investors who financed Indian railway construction were guaranteed a fixed annual return of 5% on their capital. If the railway ran at a loss, if it failed to generate sufficient freight revenue, the Indian colonial government made up the difference directly from Indian tax revenues. The British investor faced no market risk. The Indian taxpayer absorbed all of it. Infrastructure in colonial economics is not what it appears to be. It is the circulatory system of the extraction mechanism, built at the subject population's expense, to move wealth in one direction. In 1867, an Indian cotton merchant and political economist named Dadabhai Naoroji stood before a meeting in London and made an argument that no one in that room wanted to hear. He had spent years analyzing British trade statistics, Indian fiscal statements, and colonial treasury accounts. And what the numbers told him was this: India was not being developed. India was being drained. Every year, a substantial portion of India's fiscal output, collected from Indian farmers and merchants as land taxes, left the subcontinent and arrived in Britain in the form of goods exported without equivalent payment, administrative charges remitted to London, interest payments on colonial debt, salaries and pensions for British officers, and profits on British-owned businesses that were repatriated rather than reinvested. He called it the drain of wealth, and he quantified it. In his 1901 Work, Poverty, and Un-British Rule in India, Naoroji compiled the data to demonstrate that the colony was being systematically impoverished by the very empire that claimed to be improving it. The answer is not that the British were uniquely cruel. The answer is that the system was designed to produce exactly that outcome. Capital flows uphill to where the institutional power sits. And for 200 years, the institutional power sat in London. The colonial loop economy required one essential condition to function: that the colonies could not compete. And Britain enforced that condition with legislative precision. The Navigation Acts, established in the mid-17th century, mandated that all colonial trade travel on English vessels. Colonial producers could not sell directly to European competitors. Raw materials went through Britain. Finished goods came from Britain. The route was not optional. When Indian textiles threatened to undercut British domestic weavers, Parliament passed the Calico Acts, legislation that imposed punishing tariffs on printed and dyed Indian cotton imports, and at certain points banned them outright. These restrictions remained in force until British mechanized manufacturing could produce cotton cloth at a cost no hand weaver anywhere could match. The result was deindustrialization on a historic scale. India's share of global manufacturing output fell from approximately 24% in 1750 to under 2% by 1913. Skilled weavers who had supplied global markets for centuries became subsistence farmers or urban laborers. Entire craft traditions collapsed within 2 generations. This was not the market operating freely. This was a market that had been legally and militarily restructured to ensure one outcome: that value addition happened in Britain, and raw material extraction happened everywhere else. Every system built on extraction has a catastrophic failure mode. For the British Empire, it arrived in the form of famines, not one, not two, but a recurring series of food crises that killed tens of millions of people across India, Ireland, and Africa over the course of 2 centuries. The structural mechanism was always the same. A crop failure reduced food availability. The colonial administration, committed to free market orthodoxy and the maintenance of export revenues, continued to export food even as local populations starved. Relief measures were delayed, insufficient, or conditioned on work requirements that the physically weakened could not meet. And the result was mass death at a scale that statistics struggle to convey. During the Great Irish Famine between 1845 and 1852, approximately 1 million people died of starvation and related disease. During the same period, Ireland continued exporting food to Britain. The Whig government in London, committed to the principle of non-interference in markets, refused to halt those exports or provide sufficient public relief. 2 million more emigrated, reducing Ireland's population by roughly 25% within a decade. In Bengal in 1943, within living memory, an estimated 2 to 3 million people died. As Nobel laureate Amartya Sen demonstrated, this was not primarily a food supply failure, it was a price failure. Wartime inflation had driven food prices beyond the reach of rural laborers. The colonial administration's wartime policies, which had deliberately destroyed boats and stocks to deter Japanese invasion, removed the safety nets that might have compensated. People could not afford to eat. The food existed. The entitlement to access it did not. The structural observation is this: an economic system that prioritizes capital extraction over population welfare will produce death when the underlying conditions shift, not as an anomaly. As a predictable outcome, the profits of empire did not simply sit in a treasury. They built institutions that generated further profits, and those institutions outlasted the empire itself. London's emergence as the global financial center was not organic. It was a consequence of imperial capital flows. The surplus generated by trade with India, the Caribbean, and Africa accumulated in the City of London. Merchant banks deployed that capital globally through bonds, insurance, and trade finance. The pound sterling became the world's primary reserve currency, which meant that even nations not under British rule were transacting in British financial infrastructure and paying, at each transaction, a small fee to the London clearing system. Think about what that meant in practice. A Brazilian coffee merchant selling to a German buyer, settling in sterling through a London clearing bank, generating a small but continuous revenue stream for British financial institutions that had no direct involvement in the trade. Multiply that across millions of transactions annually, across the global economy, and you understand why the City of London was not just wealthy. It was structurally positioned to skim a percentage from commerce happening everywhere on Earth. The Royal Navy enforced all of it. When the Qing dynasty in China refused to open its markets to British trade, the Royal Navy resolved the disagreement through the Opium Wars of 1839 and 1856. China was compelled to open treaty ports, accept British extraterritorial authority, and permit the importation of Indian-grown opium, a trade that generated revenues that partially offset the cost of administering India. Naval power was not separate from economic policy. It was the enforcement mechanism of economic policy. A gunboat is an expensive instrument, but it is considerably cheaper than accepting a no from a market of several hundred million potential consumers. By the mid-19th century, Britain shifted from mercantilism to free trade, repealing the Corn Laws in 1846 and progressively dismantling the Navigation Acts. Historians John Gallagher and Ronald Robinson describe this as the shift to informal empire, using industrial productivity, commercial credit, and naval leverage to dominate markets without bearing the administrative cost of governing them directly. This looked like liberalization. It was not. Britain had already achieved such industrial dominance that open markets worked in its favor. Free trade was the policy of a nation that had already won and now wanted to lock in the result. Assume the imperial system runs under favorable conditions. India produces agricultural surpluses, the railways move goods efficiently, the Lancashire mills operate at capacity, and colonial markets absorb British exports without significant resistance. Assume no major wars, no catastrophic famines requiring emergency expenditure, and no serious challenge to British industrial productivity. In this scenario, the empire generates consistent returns. The City of London accumulates global capital. Domestic industrialists enjoy protected markets and cheap inputs. The British state funds its operations partly through colonial taxation rather than entirely through domestic revenue. Living standards in Britain rise steadily across the Victorian period. The return on imperial investment, measured in industrial growth, financial centrality, and geopolitical leverage, is positive. The optimistic case was real for a period. Between roughly 1840 and 1900, Britain captured the returns of that scenario. Industrial output surged. The pound sterling was the backbone of global finance. British exports dominated world markets. Now introduced the variables that actually existed. Two world wars within 30 years drained the British treasury completely. World War I converted Britain from a global creditor to a debtor nation. World War II required Britain to fund operations across multiple continents simultaneously and to pay for it by issuing paper sterling credits, promising to pay later in pounds. By 1945, Britain owed India alone between £1.5 billion in these so-called sterling balances. When Britain attempted to restore sterling convertibility in July 1947, a condition of the American loan that had kept Britain solvent, global demand to cash in those pounds for dollars triggered a liquidity crisis within 5 weeks. Britain suspended convertibility and acknowledged implicitly that it could no longer honor the financial obligations of empire. Within months, India and Pakistan were independent. Within 2 decades, most of the formal empire had been dissolved, the gap sentence. The difference between the empire that Britain built and the empire Britain could sustain was measured in 2 world wars and a century of deferred costs finally coming due simultaneously. The formal empire ended. The architecture did not. The City of London remains one of the world's top financial centers, routing international capital, foreign exchange transactions, and maritime insurance through the same institutions built on imperial surplus. A network of British overseas territories, the Cayman Islands, Bermuda, the British Virgin Islands, functions as offshore financial infrastructure that traces its legal and institutional roots directly to the colonial period. These territories are not historical curiosities. They are the modern iteration of the same principle. Jurisdictions that exist, functionally, to route capital in ways that reduce friction and regulatory oversight, concentrating financial benefit in a narrow set of institutions with deep roots in the imperial era. English is the language of international business. Common law governs the majority of cross-border commercial contracts. Global maritime trade routes run along channels that the Royal Navy secured in the 18th and 19th centuries. The World Bank and International Monetary Fund, established under American leadership after World War II, nonetheless embedded institutional frameworks heavily influenced by British imperial economic doctrine, including models of development that prioritized export-led growth and primary commodity specialization in precisely the countries that the colonial system had already locked into those patterns. And the former colonies? They inherited narrow tax bases, export-dependent economies built around primary commodities rather than manufactured goods, infrastructure designed for extraction rather than internal development, and institutional frameworks optimized for colonial administration rather than sovereign economic management. Post-colonial economic catch-up has been real in some regions and absent in others. But the structural starting point was not neutral. It was the result of deliberate policy over 2 centuries. You cannot undo in 50 years what took 200 years to construct. So here is the final accounting. For the British investor class, the empire generated extraordinary returns. For the British industrial sector, it provided cheap inputs and captive markets. For the British state, it provided geopolitical leverage and fiscal capacity. For the City of London, it provided the capital flows that built a financial architecture that still generates income today. For the populations on the other side of that ledger, in India, in sub-Saharan Africa, in the Caribbean, it provided deindustrialization, famines, enforced dependency, and an economic starting position in the post-colonial era that was decades behind where they would have been without it. Utsa Patnaik's $45 trillion estimate of the drain from India alone is not a number that fits easily in the mind. It is not meant to. It is meant to convey the scale of a transfer that ran continuously for nearly 2 centuries in one direction. Britain may have relinquished its territories. But the economic system it engineered, the primacy of London finance, the specialization of the global south in primary commodities, the dominance of English language legal and commercial norms, the offshore financial network, did not decolonize when the flags came down. So the next time you look at a global trade route, a cross-border commercial contract, or an offshore financial center, remember, you are not looking at the neutral outcome of free markets operating across equal participants. You are looking at the preserved infrastructure of an empire that turned the entire world into a revenue model and never quite dismantled the machine it built to run it.